Hello guys, welcome to Know Your Alpha. Today we are going to discuss about how to optimize credit risk management using artificial intelligence and machine learning. Very interesting subject, right? Let's get dive in. So what is credit? Credit refers to the trust extended by a lender to a borrower, allowing the borrower to access funds with an obligation to repay over time. So what are the types of credit? In general, there is like retail credit, commercial credit. When it comes to your personal loans, your credit cards, your mortgages, they comes under retail credit. When it comes to your business loans, corporate finance, trade credit, it comes under commercial credit. So what are the traditional credit underwriting methods? There are 5 C's of credit analysis that is taken over here. Traditional credit underwriting relies on a structured framework known as the 5 C's. So what are those 5 C's? Number one, it's character. Borrower's credit history and reputation comes over here. The second one is capacity, which says about borrower's ability to repay based on income and existing liabilities. Next, capital itself, borrower's savings and net worth. Next comes collateral, assets pledged as a security for the loan. Next comes conditions, external economic and industry factors affecting repayment ability. So what are the limitations of traditional credit underwriting then? So subjectivity, heavy reliance on manual decision making. So whatever decisions you're making it completely on manual. Limited data sources. You primarily depend on their historical financial data to take a decision. Time consuming. Manual processes, they take a lot of time, right? Because it slows down the proposals. And your delivery time, your TAT increases. And higher default risk. Inability to accurately predict future defaults. So here are the limitations of traditional credit underwriting. How does the credit risk management happen in financial institutions? What are their objectives? It is to minimize your non-performing assets. It is to enhance your risk-adjusted return on capital and to ensure regulatory compliance based on your Basel norms, IFRS, GDPR, etc. So what risk assessment models they use? They use credit rating systems, probability of default models, loss given default estimation models. These are some risk assessment models used in credit risk management. And we have seen that traditional credit underwriting is not supporting this credit risk management to that extent, right? Next, evolution from traditional to AIML based methods. Now we are going to see how we are moving from traditional to artificial intelligence and machine learning based methods. So looking at the shortcomings of traditional models, which are rigid and rule based, unable to adapt to new risk indicators. You have limited predictive power. It failed to detect complex patterns in borrower behavior. And data constraints primarily use past financial records and ignores alternative data sources. So this is how you move from traditional to AML based methods. These are to overcome these shortcomings. So what is AIML credit risk management? So what are the machine learning techniques used over here? It's supervised learning. Your credit scoring, your loan approval predictions happen through supervised learning. So in this supervised learning, you will have labels. You give some labels to the data and you just say your credit score, your loan approval predictions happen based on that. And unsupervised learning techniques where they will not be having any pre-trained data and you just use techniques of unsupervised learning, be it clustering or anomaly detection for fraud detection and customer segmentation. So coming to the next one, it's natural language processing. You analyze financial documents, assess sentiment from customer feedback through these techniques. And next one is deep learning. You identify intricate patterns in credit behavior through deep learning techniques. So what are the benefits of AIML credit underwriting? Faster loan processing, you are decreasing the turnaround times, increased accuracy of credit scores, reduction in manual errors and biases. So in addition to the traditional data which you get from bureaus and all the behavior, you also getting data from alternative data resources, right? From your social media, from utility payments, how the borrower is behaving. And you are just taking that real-time behavior into account in this AIML credit underwriting, which is crucial, guys. So let's look about the differences between the artificial intelligence machine learning based scorecard and traditional scorecard. Coming to the features, in data sources, in traditional scorecard, we use credit history and financial statements. Whereas in AIML based scorecard, we use social media data, transaction data, alternative sources of data, in addition to your credit history and financial statements. Coming to the feature, decision process. In traditional scorecard, it is manual and rule based, whereas in AIML based scorecard, it is automated and dynamic. Coming to the feature of model complexity, in traditional scorecard, it is linear regression based. In AIML based scorecard, it's advanced ML models use random forest, XGBoost, neural networks, etc. Coming to the feature of processing speed, in traditional scorecard, it's very slow. In AIML based scorecard, it's in real time. Coming to the feature bias and subjectivity, in traditional scorecard, it's high. In AIML based scorecard, it's reduced. Your biases you are reducing over there, right? Coming to the important feature, accuracy. In traditional scorecard, it's moderate. But what do we need, right? More accuracy. That is what you get here in AIML based scorecard. So what are the use cases of AIML in credit risk management? First one, credit risk assessment. AI models predict loan defaults with greater accuracy by analyzing past behaviors and real-time data. For example, Lending Club organization uses AI for personalized credit underwriting. Next important feature, fraud detection. Machine learning detects anomalies in financial transactions to prevent fraud. For example, PayPal uses AI for fraud prevention in payment transactions. The next important feature is customer segmentation. AI categorizes borrowers based on behavior and risk profiles. For example, fintech companies leverage AI for targeted loan offerings. The next important feature, loan recovery and collection strategies. AI predicts potential defaults and suggests optimal collection strategies. For example, AI-driven chatbots are used for debt collection in major banks. So what are the case studies for AI in credit risk management? If you just look at some organizations like JP Morgan Chase, they use AI to improve credit risk modeling, assess default probabilities. In organizations like Just Finance, it is using AI-powered credit underwriting using alternative data sources. Coming to the Indian fintech sector, it is using AI-based digital lending platforms, assess borrower risk using non-traditional data, be it in mobile payments, e-commerce transactions, etc. So what are some challenges and risks of AI in credit risk management? Data privacy and security, right? AI models rely on sensitive customer data, raising concerns about data breaches and compliance with GDPR and CCPA. These GDPR and CCPA are data security protocols. Next one, model interpretability. It's a black box problem, right? Many AI models, they lack transparency, making it difficult to explain credit decisions to regulators and customers. There is this explainability problem. Algorithmic bias and ethical concerns. AI models trained on biased data can lead to unfair lending practices. So we have to ensure the bias is reduced over here. Then only you will have good models. Next one is regulatory compliance. Financial institutions must align AI-driven underwriting with global credit regulations. So what are some future trends in AI-driven credit risk management? Explainable AI, that is what we discussed. What is happening inside? For transparent decision making, you need to increase this explainable AI component. Real-time credit decisioning. Instant loan approvals based on AI-driven risk assessment. Blockchain integration to secure credit transactions using decentralized finance platforms using blockchain. Federated learning for data privacy compliance. All AI models trained across multiple institutions without sharing sensitive data. So our AI models should be trained across multiple institutions without sharing your sensitive data. So what is the conclusion? Key takeaways from this credit risk assessment using AIML. AIML or transforming credit risk assessment by enhancing predictive accuracy and efficiency. Traditional models still hold relevance but need augmentation with AI-driven insight. This is a key guys. Your traditional models, they still hold relevance, but you use AI-driven insights to bring more augmentation to your models. Explainability, fairness, and regulatory compliance will shape the future of AI in credit risk management. Financial institutions must strike a balance between innovation and responsible AI adoption. So my final thought is AI will not replace credit risk managers. We are hearing a lot right nowadays. AI will replace jobs and everything. Okay, it's no, even though the jobs will be replaced, new jobs will be created. So per se, AI will not replace credit risk managers, but those who use AI, we will certainly replace those who don't use AI. So AI credit risk managers will replace those who don't use AI credit risk management. Thank you guys. Thanks for watching.